Okay guys, very good morning. Hope you all had a great weekend. Monday the 12th of December then. There's obviously quite a lot to talk over, both over the weekend and then also a couple of things to look out for certainly this week in the form of the Fed. So let's just have a look at the markets this morning, and the one chart that really stood out when I first sat down this morning was obviously crude. So I guess most pertinent to start on that asset. And we've had this big jump to the upside on the reopening of electronic trade. Since Europe came in, we had another slight push up to retest those highs around 54.50 before then seeing a bit of a pullback, but already up at the 54 handle, so $2.50 higher on the session. Looking technically then, this is important because we kind of, on the OPEC meeting, we had that kind of run up, the agreement that they managed to club together with a OPEC and non-OPEC cut of 1.2 million barrels per day. And we got close to testing that key 52 level, which was obviously that kind of double top from this year, from both June and then more recently in October. We've managed to really get above there now. So I would say upside targets 55 and then beyond there. Obviously 60 is probably the next area of consolidation of price in which we'd have to go back to, I guess, the summer of 2015. So a quick look at the reasonings then behind such an aggressive move this morning. You've probably read some of the headlines, but just to give you a summary. So oil surging as the Saudis eye deeper cuts while non-OPEC joins the deal. So in summary, non-OPEC countries have joined in with production cuts. Indeed, the latest update is that Russia, along with 10 other non-OPEC members, have agreed to a production cut of 558,000 barrels per day. This is in conjunction with the 1.2 million agreed OPEC members at the Vienna meeting on November the 30th. This is then in addition as well to this article where they're basically summarizing the Saudi contingent, their comments saying that they would also be willing to go further with their cut. So you've got 1.2 million that was previously agreed, plus now an additional just over 550,000 from non-OPEC, plus a commitment from Saudi to possibly do more than they've already said they would do from that meeting just around 2 weeks ago or so. So fueling prices higher again in crude oil. Let me just have a look. I mean, that's pretty much the gist of the story, and I think really it's more to do with the fact. So we've been a little bit bearish about the prospect of this deal really having the legs to go through, just given the fact that on prior occasions commitments from OPEC, and when you start including non-OPEC names such as Russia, you would have thought that it'd be very difficult for them to actually come together and implement or at least push through an agreed framework, and that's certainly what they've done. And I think that's why as well you've had quite an aggressive reaction in the crude market really ever since we started rallying when we broke below $40, which actually wasn't that long ago. It was only a beginning of November, so really a month. But this has taken quite a few people by surprise, their commitment and ability to be able to compromise to find a solution. And quite a lot of the press articles this morning are talking about, and this is one from Goldman Sachs, that non-OPEC output deal cut is aimed at inventory glut. And this is one of the main things, is that a lot of people were questioning that the 1.2 million originally agreed at the end of November in Vienna, how much of a material impact would that actually have given the large proportion of oversupply that's already evident in the market. And actually now I think that there's a concerted effort amongst these countries, these oil-producing nations, that they know that they have to remove this glut and helping curb output to reach that goal of normalization of inventories. That's really critical for them to actually be able to lift this price higher. Because there would have been, I would say, marginal returns from the size of the cuts that they originally had agreed. Hence, they want to do a little bit more now. Obviously, as the price goes higher, we start getting to 55. That's probably the next psychological target upside. And then if we were to approach 60 ultimately, The thing to then be keeping an eye on will probably be centered around things like US operational rigs, the output out of North America, to see whether or not the shale industry starts to put facilities back online, and then how does that influence the price of oil, which would be counterproductive for what OPEC are trying to achieve with the size of the cuts that they're aiming for. So a bit of a longer play, I guess, as prices go higher now, as to the state of play of which then the US, how quickly they can respond. And then that will dictate then how quickly as well OPEC will need to put into play these agreed quotas and so forth. So that's the kind of oil picture for the moment. The other thing we've got then, looking at the charts, equities, I mean, we gapped up and then started selling off in the futures. Since the cash open, we've also just drifted down. I would say, though, that I don't think that there's an overriding negative in the market this morning, because if you put the DAX on a bit of a longer dated chart, I mean, that last big candle there, that was last week. So last week we had a phenomenal move higher, given obviously we were reacting at the beginning of the week to the Italian referendum, and so that really caught, I think, a lot of people by surprise, the way the market really reacted to that, and then we just continued to grind out the week. I think it was 5 consecutive up days, so certainly well above 11,000, so a little bit of a pullback here. I mean, putting it into perspective, this is a fraction of a pullback from the gains that were seen in the entirety of last week, so I don't think it's that surprising. Actually, news flow around Italy, there's certainly been some developments as well on that subject over the weekend, so let's have a quick look at that. And Italy's next PM might not keep job for long. That's the headline that Bloomberg are running with. So essentially, the president of Italy has appointed a designate premier of Paolo Gentiloni, who, according to these reports, may only keep the seat for his former boss Matteo Renzi for a short time. Now, the appointment of this chap is quite interesting, because essentially he was part of the Renzi and quite higher ranking in the PD party anyhow. So if anything, actually there's quite a lot of continuity in that regard. He was the foreign minister in the Renzi government setup. The other thing as well, the market's reacting so positively to the Italian situation last week, and something that I read in this article, which is obvious now having just seen it listed, but you've had all of the this is the 4th unelected premier of Italy we've had in a row. Mario Monti, Enrico Letta, Matteo Renzi, and now this latest chap, Gentiloni. They've all not been appointed in a democratic vote. They've literally been forced into place by the president in order to kind of as a short-term stopgap that ends up being a running government in the case of Renzi. But this is interesting because Renzi, by no means unlike David Cameron, let's say, on the Brexit, where he kind of has completely been removed, if you like, from the political scene in the wake of that, Renzi is still looking now to be prevalent on the scene and looking to call for new elections. Obviously, there's a couple of other things that are key here. Obviously, that the person in place now at the helm is someone closely aligned to him and his thinking. And then really important is the finance minister is also being kept in place, which is Pier Carlo Padoan, who this is really important for markets' perception over the fate of Monte de Paschi. So actually there's very little change that's going to happen in immediate effect in Italy at this point. And I would say that's probably going to bring some degree of confidence over that situation. In fact, Italian banks, when I last looked this morning, likes of Paschi already up 5-6% this morning. Italian banks on the front foot. Paschi in particular, there was this also article from the weekend. So Paschi proceeds with their capital plan to avoid a state rescue. So they're still looking to press ahead with their €5 billion capital increase in order to avoid a state rescue. That would obviously be more positive for the sector and perceptions over the health of Italy if they can privately raise capital rather than resorting to a full-on state bailout, so to speak. So that's your kind of Italian situation. But moving on, there's obviously another big event coming up on Wednesday night, and this probably wraps up, I'd say, 2016. Before then, things likelihood going into that week of the 19th and the run into Christmas probably get very quiet, as they always do. So let's have a quick look at the Fed. What signal will the Federal Reserve send? Now this is really important because it's pretty much 100% priced in that the Fed are going to hike interest rates. Don't think the market is particularly fussed about that occurring. We've now got used to the premise of that. That obviously in T-notes, if we just have a quick look, the US 10-year yield above 2.5%, first time I think in 2 years. Looking at T-notes this morning, already down 13 ticks, but if you put it on a daily continuation chart, obviously this is where Mr. Trump won the US election, and since that point we've essentially gone from a 129 handle all the way down to looking to flirt with 124. Now it's a phenomenal increase in US yields on the back of really twofold: the Trump administration's fiscal plan, and then the implication that will have on inflation, and then ultimately forcing the hand of the Fed to potentially be more hawkish with their interest rate trajectory as we go into this new cycle of interest rates. And this is important because it's not the hike that people will be watching this Wednesday evening, it's this, which is the dot plot matrix and the projections of the Fed's hikes through 2017, 18 and longer term. So you can see here, the market expectations is the line. Here is what the Fed dot plots, the previous ones in September, so the existing forecasts are indicating. So for 2017, we're roughly on track for how the market's priced, but 2018, 19 and going on, obviously the Fed are a lot more hawkish than where we are in terms of market perception. So it's going to be really key on how she communicates as to what the decisions will be as to justify any movement of that trajectory going forward. So obviously you've got the statement, you'll get the summary of economic projections update for December, which will be very important, and then you'll get the press conference with Yellen. So it's going to be the full affair, and we will be open later that evening to cover in full. Question marks then around this will be, will US equities maintain their bullish momentum? Obviously they've got a good shot in the arm on the back of the promise of what Trump is going to be looking to do going forward, but obviously we've talked about this a few times. There is a Trump implementation risk, definitely. Coupled that then with political risk coming out of Europe in the form of France, ongoing Italy, and then the Brexit with the UK and Europe, then some question marks about this being an over-elevated move with potential for a correction. My only thoughts on this would be that certainly in European equities, when you have someone like Draghi, basically I don't even think you can call it a dovish taper. Taper, as he rightly said in the conference, was not discussed. And if things get worse, I think the ECB will only continue to backstop the market. So very difficult, I think, to really believe that there'll be any type of aggressive correction in equities. But certainly with US stocks, this is a daily candles. So you can see last week we broke technically that important test on that level back on when OPEC promised to cut and an oil rallied over 10%. We broke that last week, and since then we've just continued to power higher. But how long can this sustain, this upward move? Certainly what the Fed are going to tell us about rates going forward for next year and beyond will be really critical to the direction short term on where this goes, whether up to 2300, or do we start to get a bit of reversal and fatigue on this rally that we've had. So certainly there's things to look out for from the Fed. That moves us then on to the next central bank, which we'll hear from this week. And that, of course, is the Bank of England, who I'd say have largely taken a bit of a back seat because we're in a bit of a hiatus, I guess, a sit on our hands situation for the time being. The Bank of England obviously committed to a large degree of easing in August. That got taken back slightly. I think it was September when inflation started to creep up and signs about this wordplay about tolerance for higher inflation. Well, this is going to be really key to look out for with the Bank of England. We'll obviously get the decision. We're not expecting anything to happen there, but it's the language which materializes from the minutes which will be important. And actually looking at Bloomberg's article, they're looking at the analysts surveyed by Bloomberg between December the 2nd to the 9th, so essentially last week. And 61% say that the next interest rate move for the UK will be higher, not lower. So this is a great contrast to where we were only a few months ago, when we were committed that the lower bound for interest rates was just above zero. They were indicating that we could cut further, and now here we are, the market's now repositioned for the fact that actually rates are more likely to go up than down. And this is all really down to the fact of fears of higher inflation coming into the market over the coming months. Now this is certainly something which will be really big, I'd say, in Q1 and the first half of 2017, because inflation will keep rising. But at this same point, we're also going to get into the kind of real difficult part of the Brexit talks, because the triggering of Article 50 obviously is at the end of March. So you're going to have fragility politically over the sentiment dealing with negotiations with Europe, counteracting with rising inflation. Puts the Bank of England in a bit of a rock and a hard place. So it'll be interesting to see how they deal with that. Obviously, looking at cable, we had quite a significant test of a big level last week, which was that 128.06. We didn't quite get there. We got up to 27.77 before turning lower. I think that level is really important. That's that kind of post-Brexit low and support and now resistance. And I think that's likely to hold, in my opinion, certainly until we get a bit more clarification over the Supreme Court ruling. And on that subject, a couple of articles at the weekend, if you haven't already caught them. This is a Telegraph. Supreme Court Brexit appeal, judges heading for a split 7-4 decision in narrow win for Remain campaigners. So still ratifying the UK High Court decision that parliamentary officials must have a say, but actually common consensus was that would probably be something more like 9 or 10 to 1, whereas actually it's been a lot closer than many had perceived. I did put this into the chat earlier and I have tweeted it, so maybe just worth a read, essentially saying that it's likely to go the way that most people had expected, but the vote was a little closer than maybe some were looking at. Separately, over the weekend, a new Article 50 court challenge to go ahead after thousands are back to campaign. Now this is specific for Ireland. So essentially the challenge, which will now go before Ireland's High Court, contends that Article 50 should be revocable once it's been activated. And under EU law, a member state has 2 years after, as we know, Article 50 is triggered. But the new legal bid argues the European Council and European Commission may have breached EU law in relation to Article 50. So more and more headaches here for the existing ruling government on this Article 50 situation. And I only see this as being more net negative, because the longer it takes for us to make a resolution domestically, the latter it's going to be when we can start actually getting down to business and having some sort of meetings with Europe. What we'd want to be doing, hypothetically, is having some soft talks, I would say, behind closed door in an informal manner ahead of the triggering of Article 50, so that the ball is already rolling. At this point, we can't even sort our own house out, which is being problematic, because dealing with all this legality issue within the UK or Great Britain and how this is going to play out is only wasting time in what's going to be an extremely tight time frame as soon as Article 50 is triggered, because as we know from the last 2 weeks, it's not going to be 2 years, because Europe have said they need 6 months in order to ratify the agreement across the various European parliaments. So in reality, we might have as short as 15 to 18 months. That's granted unless there's a transitional period then after agreed, but obviously that plays into the hands of Europe, I would say, from a negotiating point of view. So I'd be interested to see whether how this cable trade plays out. Obviously there's the inflation aspect, which makes this obviously more bullish for the pound, but I think overall that's defined upside by that 128.06 technically, and then I think the overriding sentiment will be a negative one, and that buyers should win out in the months ahead as Brexit starts to play out, but we shall see. Certainly a couple of other stats as well I just wanted to run by you from this morning. So for T-notes, that was one. Actually, so it's been T-notes seen the biggest 5-week fall since December of 2010. So that's just pointing to that move above 2.5% we've had in the US 10-year. And dollar yen has been, if you think about where we were a few months ago, and Kuroda was panicking about the strengthening yen, the ramifications that was having when we were under 100 there in the pair. Look where we are now. Through much of summer of this year, during the various risk events being Brexit, as you can see is already highlighted on this chart that I've got, the inability for the Fed to pull the trigger, the Italian sell-off that we had in September. Since then we've just, this strength of the dollar has really helped that yen weaker, and that's helped the Japanese exporters for sure. But in terms of dollar yen, statistically, having rallied for a 5th week in a row last week, it's the biggest 5-week gain for dollar yen since 1978, to put it in some context for this moves that we're seeing here. Phenomenal rally that's been going on there, and this is when you have to look across different currency pairs and crosses for identifying actually where is potentially the best trade. And certainly upside in dollar yen has been a real prevalent theme in the financial markets, so maybe something for you live guys to keep an eye on. Just wrapping up then, a quick look at the calendar for today, and I'm afraid it's going to be very quiet from a schedule point of view. Really nothing of significance today, so it's going to be more a case of digestion of the current news flow that's out there. It would also be very interesting to see how oil plays out when NYMEX opens later, and how the US interpret this gap up that we've had and this move towards nearly a $3 gain. Do they push it up to 55 will be a key level to keep an eye on. Okay guys, that's the morning briefing. So again, I hope you all had a good weekend. I'll be in the chat room for the rest of the morning, so enjoy your day. Thank you.